Welcome to vTalkInsight Allocator's Lens Daily for December 19th, 2025. Disinflation headlines, AI-driven earnings, and diverging central bank paths are pulling markets in different directions, so cross-asset relationships are doing more of the heavy lifting for portfolios. Let's start with equities, where that tension between softer inflation and late-cycle risks is most visible. In equities, the picture is one of strong, fundamental momentum meeting a more volatile tape. Recent inflation data in the United States surprised the downside, with headline consumer prices easing to around the mid-2% range and core inflation even lower, reinforcing expectations that the Federal Reserve could move toward rate cuts next year. That backdrop has generally supported risk assets. Yet the main U.S. equity index has swung between 1% down days and solid rebounds, while the volatility index has drifted up toward the high teens. Under the surface, breadth has improved versus earlier in the year, with more stocks making new highs and a greater share of the index trading above key moving averages, even as leadership from mega-cap technology names remains dominant. The constructive side of the story is earnings, especially around AI. Aggregate earnings estimates for the large-cap U.S. index have been revised higher for 2026 and 2027, now pointing to low to mid-teens growth, helped by expectations of productivity gains from artificial intelligence, lower corporate tax rates, and a somewhat weaker dollar. Importantly, that growth is no longer seen as purely a mega-cap tech phenomenon. Healthcare, industrials, and other sectors are expected to contribute more meaningfully as the cycle matures. Company-level news reinforces that optimism. Micron has reported a more than 50% jump in revenue, guiding next quarter's profits far above consensus and highlighting what it calls the largest supply-demand imbalance in memory chips in decades, driven by AI infrastructure build-out. Analysts expect memory prices and margins to stay elevated into at least 2026. And Micron says it is effectively sold out of certain AI-related products for the next 2 years. Against that strength, allocators face a growing list of equity risks. Valuations are already rich by historical standards, and the benchmark has become heavily concentrated, with technology and communication services together accounting for nearly half of index weight and 8 of the top 10 names in tech. Momentum trading has in places morphed into a dash for lower quality stocks, where price action has overtaken fundamentals. Surveys now flag a correction in AI-related equities as a top risk for the next 2 years, and the extraordinary private valuation jump for companies like OpenAI underscores the possibility of an emerging bubble in parts of the theme. At the same time, AI itself is starting to introduce new cost pressures, from soaring power prices around data centers to higher input costs and logistical bottlenecks for chipmakers. Combine that with potential hits to disposable income from higher healthcare premiums if certain subsidies expire and rising winter heating bills, and the margin outlook looks less one-sided than headline earnings upgrades might suggest. So for equities, the key watch points are how quickly AI benefits diffuse beyond a narrow leadership group, whether inflation stays on its improving path, and how the busy pipeline of mergers, acquisitions, and new listings interacts with still elevated valuations. All of that feeds directly into the debate now shaping rate markets. In rates, the front end of the curve is being pulled lower by the same disinflation story that is supporting equities. Headline and core U.S. consumer prices have fallen back into the mid-2% range, undershooting expectations and encouraging markets to price in at least a couple of Federal Reserve cuts, with some participants looking for an early move next year. The disinflation narrative is reinforced by signs of cooling shelter costs, with rents posting their largest monthly decline in many years and home prices starting to flatten, as well as cheaper oil benchmarks after a more than 20% slide from earlier peaks. That mix has already nudged investors out of purely short-duration cash vehicles, with flows moving from front-end treasury products into multi-sector and active fixed-income strategies that can lock in yields before cuts arrive. The counterweight is that the inflation picture is not as clean as headline numbers suggest. Some observers argue that recent consumer price data may be flattered by technical issues linked to earlier government shutdown disruptions and the way missing observations are carried forward in official statistics, potentially biasing reported inflation lower well into 2026. Beyond the data quirks, underlying pressures remain. Services inflation is still elevated. Shelter costs are roughly 40% higher than in 2019 despite recent softening, and wage growth sits around half a percentage point above pre-pandemic norms. Tariffs add another layer, with existing and prospective measures expected to keep core goods inflation under upward pressure for several years, just as AI-driven power demand lifts electricity costs in key U.S. regions. Reflecting those risks, central banks themselves do not anticipate a quick return to a stable 2% inflation path, and the Federal Reserve projects that target will not be met before the latter part of this decade. Globally, policy divergence and term premia complicate the rates picture further. The Bank of England has begun cutting, but a split committee and cautious language around sticky wage inflation have left markets uneasy, and the lack of clear guidance on the pace of future moves has pushed gilt yields higher after the decision. The European Central Bank, by contrast, is holding rates steady around 2%, talking tough on inflation even as its own projections show price growth slightly below target into 2026 and growth forecasts modestly upgraded. Meanwhile, 10-year yields in the United States and United Kingdom have been drifting lower from their highs, while German and Japanese yields move up as the Bank of Japan edges away from ultra-easy policy, raising the risk of Japanese investors reallocating away from U.S. Treasuries. For allocators, that means a world where short-dated income still looks attractive relative to history, but long-end yields may remain sticky if deficits, inflation worries, and shifting foreign demand keep term premiums elevated. The next key inputs will be the reliability of upcoming inflation releases and how central banks communicate around those tensions, which in turn will feed through to credit conditions. Credit markets, for now, are echoing the more optimistic side of the macro narrative. High-yield bonds remain near their highs, and spreads are tight, suggesting that public markets do not yet see broad systemic risk on the horizon. Global bond markets are in a normalization phase, with U.S. and U.K. 10-year yields easing even as German and Japanese yields rise, and that backdrop, combined with strong equity levels, is nurturing a constructive environment for funding. Current conditions are particularly supportive for mergers and acquisitions. Tight spreads, buoyant equity valuations, and healthy bank balance sheets are underpinning expectations for a surge in deal activity next year, alongside a diverse pipeline of initial public offerings across sectors and sizes. Beneath that calm surface, though, credit risks are quietly building, especially in private markets. Higher for longer policy over the past couple of years means many borrowers now face structurally elevated interest costs, and delinquencies in private credit are expected to rise into 2026. There are already examples of stress in funding for large technology and infrastructure projects, and reports of roughly 15 companies facing over-leveraged balance sheets suggest that problems are not confined to isolated fraud or idiosyncratic stories. Banks may also be more exposed than headline metrics indicate, particularly where they have indirect exposure to weaker credits through financial intermediaries and private vehicles, raising the possibility that defaults or governance issues in private credit could spill back into parts of the banking system. The reassuring offset is that large, diversified institutions with conservative growth strategies, such as some of the major U.S. banks, are seen as better positioned to weather a default cycle if one emerges. Allocation trends reflect this push and pull, with cash yields expected to decline as central banks eventually ease. Investors are gradually moving out of money market funds into higher income opportunities across public bonds, equity income, and private credit. At the same time, some allocators judge that the traditional diversification role of benchmark bonds has weakened and are seeking ballast in areas like commercial real estate, infrastructure, hedge funds, and gold. That makes monitoring the credit cycle especially important. Early signs of rising defaults in private credit, any widening in high-yield spreads from currently tight levels, and bank commentary on indirect exposures to stress sectors will be key indicators of whether today's benign pricing can persist. Those dynamics are tightly interwoven with the evolving currency landscape. Currencies are increasingly reflecting the same policy divergence that is shaping rates. As U.S. inflation cools and markets price in Federal Reserve easing, the dollar has started to lose some altitude, providing a tailwind to non-dollar assets and to U.S. companies with large overseas earnings. In Europe, the picture is more nuanced. The European Central Bank is on hold and continues to talk tough on inflation, even though its own projections show price growth running below target for several years. That stance had encouraged some to position for renewed hawkishness, but if that tone softens, the euro could be vulnerable to renewed weakness. Sterling faces its own cross-currents. Markets have been convinced that the Bank of England would cut, but a divided committee and lingering concerns over wage growth raise the risk of policy outcomes that are less dovish than priced, a setup that could see the pound rally if expectations are disappointed. Digital assets add another layer to the FX complex. Crypto prices rallied sharply after the latest downside surprise in U.S. inflation, with Bitcoin moving toward the high 80,000 range and other major tokens also gaining, underscoring how this space can act as a high beta expression of macro views on real rates and liquidity. At the same time, the regulatory backdrop is shifting in a way that could make crypto more investable for traditional institutions. Lawmakers in the United States are reported to have agreed on most of the text for comprehensive market structure legislation, while securities regulators have issued guidance that allows broker-dealers to hold tokenized securities under defined safeguards, opening the door to more on-chain versions of traditional assets. For allocators, that combination of greater regulatory clarity and elevated price volatility means FX and crypto exposures are becoming more central to portfolio construction. The key variables to watch are how quickly the Federal Reserve moves relative to the European Central Bank and Bank of England, and the pace at which new crypto rules and tokenization initiatives are implemented, all of which will set the tone for currency returns and correlations. Commodities round out the cross-asset picture with a mix of disinflationary and inflationary forces. In oil, fundamental oversupply is still the dominant theme. Non-OPEC production growth is outpacing demand by several 100,000 barrels per day, and benchmark crude prices are down more than 20% from earlier in the year. That has occurred despite heightened geopolitical tensions involving Russia, Iran, and Venezuela, as sanctioned barrels continue to find their way to end buyers. Analysts note that if geopolitical risks fade further and demand softens, crude could test levels around $50 or even dip into the 40s, although U.S. shale producers have become efficient enough that meaningful supply cuts may not materialize unless prices fall a few dollars further. Lower oil prices support the disinflation narrative and relieve some pressure on consumers and corporate margins. Even a short burst of price strength can still lift energy equities, as seen recently in Europe. Elsewhere in the energy complex, AI is reshaping the inflation outlook through power markets rather than fuel alone. Capacity auction prices in the PJM electricity region have jumped from just over $2 billion annually to more than $16 billion, driven by surging data center demand linked to AI growth. That is feeding into higher electricity prices across parts of the Midwest and Mid-Atlantic, contributing to inflation pressures for households and businesses, even as oil falls. On the supply side, manufacturers of natural gas turbines are reportedly sold out for several years, making it difficult to expand generation quickly, which in turn elevates the strategic importance of nuclear power as a longer-term solution. Utilities positioned near major hyperscale data centers may benefit from this dynamic through stronger pricing power and potential policy support, while select metals, such as platinum, could see increased demand after the European Union's decision to allow internal combustion engine vehicles to remain part of the fleet. Finally, precious metals are acting as a barometer of both macro and geopolitical unease. Gold and silver have drawn strong interest from central banks and private investors amid concerns about fiat currency debasement, de-dollarization, and persistent geopolitical risks ranging from the Russia-Ukraine conflict to rising tensions over Taiwan. Those flows sit alongside broader moves by allocators to seek diversification outside traditional bond equity mixes, with gold in particular featuring as a hedge against both inflation surprises and financial system risks. Together with the energy story, this leaves commodities sending a mixed signal. Cheaper oil is reinforcing disinflation and supporting the case for easier policy, while tight regional power markets and resilient demand for real assets warn against complacency. How that tension resolves will be critical for the next leg of the cross-asset narrative. Stepping back across assets, the current configuration still looks late cycle but growth supportive, with more obvious two-way risk. Equities are underpinned by powerful earnings upgrades and genuine AI-driven demand. Yet valuations, concentration, and rising input costs leave less room for error. Rates markets have embraced disinflation and the prospect of central bank easing, even as unresolved questions around data quality, tariffs, wages, and term premiums keep the path for yields uncertain. Credit remains buoyant in public markets, helping to finance a strong pipeline of deals and listings, while private credit and bank exposures bear watching as potential sources of stress. Currencies and crypto wrap this together through policy divergence and evolving regulation, and commodities add both a disinflationary oil impulse and a reminder, via power markets and precious metals, that real asset pressures have not disappeared. For allocators, the key is to monitor how inflation data, central bank communication, AI infrastructure bottlenecks, and the behavior of credit spreads interact, since that interplay will define the opportunity set and risks into next year. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.